When you are running low on cash days before your next paycheck arrives, seeing an option in your banking app that offers an advance of up to $750 feels like a total lifesaver. You are facing an unexpected car repair, a surprise medical bill, or a utility charge that is due before Friday, and you need a quick bridge to get through the week. That is the exact problem fintech platforms like Current aim to solve with features like Paycheck Advance. But if you have ever used or considered using an instant cash advance, an underlying fear usually lingers in the back of your mind. Is this just another polished payday loan in disguise? Will using it trap you in an endless cycle where your entire upcoming paycheck is consumed before you even receive it? And what happens behind the scenes inside the app when you tap that request button? To understand how Current Paycheck Advance works under the hood, you first have to understand that Current is not a traditional brick-and-mortar bank. It is a financial technology company that partners with FDIC-insured banking entities to provide mobile accounts. Unlike legacy credit card cash advances or payday lenders, Current does not run a hard credit check or pull your credit score when you ask for an advance. Your credit score remains untouched, and there is no annual percentage rate or interest charge attached to the advanced money. On paper, that sounds almost too good to be true, which naturally brings up the core question of how the platform actually evaluates your eligibility and how it makes money from the feature. Behind the scenes, Current relies on automated risk assessment algorithms rather than human loan underwriters. To even unlock the Paycheck Advance feature, you must have an active checking account with a qualifying recurring direct deposit, usually at least $200 a month. The system constantly scans your transaction history, watching the consistency of your employer's payroll deposits, your balance fluctuations, and your spending habits. Most new users do not automatically qualify for the maximum $750 limit. Instead, the algorithm starts you off at a lower ceiling, often between $25 and $100. As your payroll deposits remain consistent over weeks and months, the algorithm gradually increases your available advance cap. Now let us break down the fee structure and where the trade-off happens. Current promotes Paycheck Advance as zero interest, and technically, if you choose standard delivery, it is entirely free. However, standard delivery takes between 1 and 3 business days to land in your account. When you are facing an urgent emergency, waiting 3 days often defeats the purpose. This is where the instant access option comes in. If you want the funds deposited in your account within minutes, Current charges an instant access fee. The exact fee varies depending on the size of the advance you request. While a $5 fee on a $100 advance might seem small at first glance, if you calculate that flat fee as a percentage over a short 2-week pay cycle, the annualized cost can actually be quite high if relied upon repeatedly. The real mechanism to watch out for is repayment. When you take an advance, you are giving the platform permission to automatically collect repayment the exact moment your next qualifying direct deposit hits your account. This automation creates 2 distinct realities. On the positive side, you do not have to worry about missing a payment deadline or getting hit with late fees. On the negative side, if you advance a large portion of your income, your next paycheck will arrive significantly lighter than usual. If your regular living expenses consume most of your salary, starting the next pay cycle with several $100s missing can create an immediate cash shortfall, tempting you to take another advance almost right away. So, what is the actionable takeaway to ensure you use a feature like Current Paycheck Advance without getting caught in a cash flow trap? First, treat cash advances strictly as a temporary emergency bridge rather than a routine supplement to your budget. If you find yourself taking an advance every single pay cycle just to buy groceries or cover regular bills, the issue is not timing, it is a structural budget deficit that requires cutting non-essential expenses or finding extra income. Second, whenever possible, plan ahead and opt for the free standard delivery speed to avoid paying instant access fees. Third, pair the advance feature with targeted savings habits. Setting aside even $20 or $30 per pay period into a designated emergency savings pod creates an organic buffer, eventually eliminating the need to borrow against your own future wages. By understanding the mechanics, the automated algorithms, and the subtle costs involved, you can leverage these modern financial tools to work for your peace of mind rather than against your financial freedom.